Welcome to the special live stream session with the release of the Consumer Price Index or the latest inflation data for the month of July 2024, which is set to be released in about 15 minutes at 5:30 a.m. Pacific Standard Time or 8:30 a.m. Eastern Standard Time. The general consensus for today's CPI is about 3% and 3.2% for the core CPI, and I'm thinking it's going to be even lower than that, but who knows? We could have a surprise and be even higher. Hopefully not. I do have Bloomberg live ready to go. As soon as the CPI report comes out in about 15 minutes or 14 minutes now, the Federal Reserve has not raised interest rates since July 26, 2023, which maintained the Fed funds rate between 5.25 to 5.5%. And we are expecting the Fed to cut interest rates in September 18th, by either 25 basis points or 50 basis points. Now, this is one of the two inflation reports the Fed needs to see before the Fed makes its decision on the interest rates on September 18th. And we have another inflation report coming out on September 11th, and that's going to be another crucial one a week before the Fed meeting. And not to mention the second estimate for the Q2 GDP is coming out in about 2 weeks. And another PCE inflation is coming out on August 27. And what the Fed is truly paying attention to right now is the unemployment rate and the labor report, which will come out on September 6th. And I've been saying this in every live stream that if the Fed is not careful, the unemployment rate could easily go up to 4.6, 4.7, even to 5% by the end of the year. And I'm really hoping that doesn't happen for our country's sake, because we just can't afford a recession right now with over $35 trillion in national debt. And the producer price index for the month of July just came out yesterday morning. And it rose way less than expected. The PPI measures selling prices that producers get for goods and services, which is on the opposite spectrum of the CPI, right? And PPI only increased by 0.1% on the month, while economists from Dow Jones were looking for an increase of 0.2% on both the all items and the core readings. And I know a lot of you are brand new to this, but we don't even need the Federal Reserve to cut interest rates for the interest rates to actually come down. Treasury yields have been moving lower for quite some time now. So don't be surprised if the mortgage rates and the rates for your high yield savings account keep getting lower. And the PPI is the leading indicator for inflation from the perspective of manufacturers and suppliers of goods and services. So when you look at the inflation data, you want to look at both PPI and today's CPI. And these indicators are all pointing to the Fed to cut interest rates on September 18th. I always feel weird when I say PPI. But anyway, but we are seeing a lot of cracks in our economy right now. And they are pretty concerning before the Fed meeting. And some economists are calling for the Fed to call an emergency meeting to cut interest rates now. But they're not going to do this unless they see another spike in unemployment. And the weekly jobless claims rose 2 weeks ago from 235,000 to 249,000, but it went back down a week later to 233,000, and that calmed down the stock market temporarily. And not to mention the U.S. manufacturing sector is still contracting in July, and we know that that sector has been in a recession for a while. And it's the lowest reading since November 2023. So the biggest concern again is these slowing signs in the labor market. So if you take a look, I'm going to refresh this real quick, make sure I get the latest data. Okay. Oh, wow. Yeah, take a look at that. So the investors are starting to price in on the 50 basis point cut instead of 25 basis points. And this is from the CME Group's Fed Watch tool. The Fed funds rates right now is between 5.25 to 5.5%. So these numbers will change almost all the time. In the last CPI live stream, I showed an article from Citigroup that they're predicting a 25 basis point rate cut at every single Fed meeting from now, from September until June 2025. and it's starting to look like it's going to happen pretty realistically. Now, I know some of you will say that 0.25% is not a big deal, but it is actually a big deal because when they cut interest rates by just 0.25%, it doesn't mean the mortgage rates and car loans will just decrease by 0.25%. They are going to go down even lower because they're going to be following the treasury yield when it goes lower too. So that's why I pay attention to the 10-year treasury notes when it comes to mortgage rates. And the SEP, or Summary of Economic Projections, in September will give us a better idea of what the Fed will do for the remainder of the year. Okay. Now, so take a look at the November one, because this is even more interesting because this Fed meeting in November happens 2 days after Election Day, and investors are already betting on the Fed to cut interest rates by another 25 basis points on top of the 50 basis points in September. And again, banks and lenders don't have to wait for the Fed to cut interest rates to cut the rates on the products like high yield savings accounts, mortgages, and CDs. They can cut rates far in advance if they believe the rate cuts are going to happen anyway. And my high yield savings account is already seeing some rate cuts from 5% to now at about 4.3%. And investors are already kind of thinking about moving their cash into equity, because now that you're not going to be paid that much in yield, and naturally people would rather probably invest instead of putting it in a money market fund. Anyway, we're getting another SCP in December, and the investors are betting on the Fed to have interest rates lower by 100 basis points from now until December. So if you're looking to buy a house soon, I would expect the rates to come down even further, but I wouldn't expect the prices to come down too. And I think the home prices will actually go up while the rates come down, because it's going to drive up demand. And we still don't have enough inventory in many cities and towns like Vegas, and that's going to drive up home prices even further. But home buyers will be more than willing to purchase a house with a 5% interest rate instead of 6.5 or 7%, right? But the biggest concern here is the unemployment rate, because even if the mortgage rates are down, if more Americans lose their jobs, they're not going to buy a house anyway. And so this labor report triggered what's called a SOM rule. And unless you're like a crazy nerd like me, you probably didn't know what a SOM rule was until everybody on CNBC started talking about it, right? The government completely blamed it on the hurricane in Texas that triggered the unemployment rate from 4.1% to 4.3%. I thought that was pretty funny, but most of us saw this coming from miles away. And I talked about this in every live stream, that unemployment is truly a concern, and nobody on the mainstream media even raised the issue until 2 weeks ago. And if you don't know what the SOM rule was, or if you still don't know what it was named after an economist named Claudia Sahm, who served as a top economic advisor during the Great Recession for the Obama administration. If you go to the St. Louis Fed's website, they keep track of the SOM rule because it's been accurately predicting a recession every single time. So when the unemployment rate in July ticked upwards to 4.3% over the past 3 months, and the average unemployment rate was 4.13%, which was higher than the lowest 3-month average from the past year at 3.63%. And these numbers trigger the SOM rule because reaching the 0.5% level means there's a recession or an incoming recession. But could this be a false warning? Absolutely. But the stock market had a sell-off for days because they were terrified of the labor report, and not to mention what happened in Japan. And this is another reason why many economists call for the Fed to conduct an emergency meeting to cut interest rates now. But I don't think that's going to happen just based on the one labor report they saw, right? So could the Fed be making a big mistake? Sure, but only time will tell. And Jerome Powell knows this. And I talked about this in depth in my private group. So if you're interested in joining my private FIRE community, you can go to FIREPsyChat.com/community or schedule a session with me by visiting FIREPsyChat.com/consultation. And feel free to download all of the resources, free resources, by visiting FIREPsyChat.com/resources. And when the report comes out, I want to pay attention to shelters, because it's been the largest contributor to the monthly all items increase. And I'm also going to pay attention to motor vehicle insurance, because the rising cost of insurance is frustrating the heck out of American people, including me. And we are expecting a 0.2% increase on both the all items reading and the core measurement. If the inflation report comes in lower than 3%, like 2.9 or 2.8%, I can see investors pricing in on the 50 basis points more than the 25 basis points for the September rate cut, because if it comes in much lower than expected, now the Fed can focus more on the labor market and not inflation. And I still think the Fed should have started cutting rates in July, but what can we do now, right? So let me get things situated, and I am going to go ahead and tune in to Bloomberg and see what they have to say while I have all of this stuff ready to go here. Make sure I put the sound on. I don't think Jerome Powell is going to raise rates, just so you know. Okay, so let's see when I get things ready to go here. All right, so it's coming out in about 2 minutes, and I have it ready to go. And it looks like it is still getting ready for the 0.2% increase. And let's see what it says. Let me see what else is going on in the market here. Yeah, the S&P 500 is doing.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio.
It's coming out shortly, but it looks like the S&P 500 futures is pretty flat. Dow Jones is also flat, and NASDAQ is also flat, as you can see. Russell 2000 is kind of taking off just a little bit. Gold's up, and crude oil is also flat. And it looks like they're kind of on standby for a pending inflation report coming out. Just looking at, well, some geopolitics going on, but yeah, a little concerned about oil. Should be okay though.
Officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Okay, should be coming up now.
We just have seconds to go before that CPI print. Here is the state of play heading into that. Not a whole lot going on.
2.9%. Wow, it's a beat.
4-day streak.
And
we are
core
seeing, though,
CPI remain at 3.2%.
Russell 2000 outperforming, and
Okay,
this
so
is
it's
the
a
reason
beat.
why. Two-year yields continuing their descent,
core CPI
as well as across the board,
meat.
although actually picking up a little bit. Just fluctuating there,
Okay.
394. Right now, we do
Shelter
have the
rose
economic data with
0.4%.
US CPI coming out. Here is Michael McKee.
Here we go.
And economists got this one right. Bang on. 0.2 increase in the core, 0.2 increase in the headline, just as forecast. Now, base effects are somewhat hard to measure. So we do see, even though we're in line with the headline number, we see it drop on a year over year basis to 2.9%. from 3%. That is better than expected, and 3.2% on the core on a year-over-year basis. That is also better than expected. And that may have to do, and we'll look this up, with the rounding that Lisa was talking about before we came on. Taking a look at some of the numbers here, we see food prices up 0.2, same as last month. Food has really come down as an overall issue. Gasoline prices were flat on the month. We saw in the PPI, remember, that gasoline prices were up, and that pushed overall goods prices up. New vehicles down 0.2, and used cars down 2.3%. Those are kind of as expected by analysts. Shelter costs up by 0.4. That's double what we saw in June. We'll have to see how that breaks down. I'll take a look at that while you guys check the markets, but that could be something that maybe worries people a little bit if it turns out to be in the home price area.
We'll give you a second to go through some of the details right now in markets. Hard to know exactly what to do with this. That's my takeaway, although marginally a little bit of a pop on the S&P 500. Bond yields kind of fluctuating, although a little bit higher. Right now, you do see an ongoing pop in that Russell 2000. Danny, that to me really stands out with the idea of rate cuts. This not necessarily impeding the prospect that the Fed will move in September.
I think here you kind of see the clear divide of how we went into this. The fact that you had bond markets in the front end rallying so much, it's undoing some of that. This morning, the front end is moving higher by about 4.5 basis points, which you wouldn't think if you saw small caps taking off. So maybe it is just the fact that we did see, I don't know, some differences in between bond and equity markets, that you did see bonds, again, price in already some very, very significant Fed cuts. So maybe it needs to undo it with.
Yeah, so like I said, if you're just tuning in, we don't have to wait until the Federal Reserve to cut interest rates to start seeing rate cuts. So like if you have a high yield savings account, you probably got to notice that your rates are coming down from, like, let's say 5% to 4.85%. They're just going to start cutting here and there. The same thing with maybe credit cards. They're going to come down just slightly. They're still going to be very high interest rates. Mortgage rates, those are the ones that most people care about, and where they're going to be in the future. So pay attention to what's going on in the 10-year Treasury note, just to if you're looking to buy a house soon.
And it is not what the Fed wanted to see. I'll continue to parse through this while you get the reaction of people who are smarter than me and certainly better looking. And we'll see what else we find.
All right. Well, joining us right now, we've got David Kelly of JP Morgan alongside Steve Rasciuto of Mizuho. David, thank you for being on with us. I want to start with you. What's your reaction to this?
I think it's pretty good news because if you look at first of all, it was slightly better than consensus in the headline. I mean, very slightly. But if you look at what's still holding CPI up, we got a 1.2% increase in auto insurance. So it's still at an auto insurance anomaly there. And we did see a 0.5% increase in rents, but that's showing the rental numbers up over 5% year over year, and owners equivalent rent up over 5% year over year. Now we know that is somewhat misleading, and I think the auto insurance number is also somewhat misleading. But everywhere else, inflation is nowhere to be seen, and I think that's really the important point. Where in the actual transactions markets of the economy, where people are sort of bidding and asking for in terms of prices, inflation is disappearing. So I think that overall, this very much confirms the idea that inflation is heading down. I think over the next 2 months.
Okay, so I do want to show you guys the inflation report here. And it looks like motor vehicle insurance went up again by 1.2%, which is pretty significant. And yeah, so pretty frustrating because my car insurance bill went up by 26% in a year. And homeowners insurance has also gone up too. So while they're talking about some of the main things about the food and energy, as you can probably tell that the food prices have kind of like flatlined, but motor vehicle insurance has risen by 1.2% in July, following a 0.9% increase in June. The index for household furnishing and operations increased 0.3%. Used vehicles and trucks fell 2.3% in July. So that's pretty significant if you're looking to purchase a vehicle, following a 1.5% decrease in June. And I can see vehicles continue to fall, which is good. And if interest rates come down, those prices will likely to fall too, because remember, the demand may go back up for the vehicles, but there's a lot of inventory in the car market right now, and unlike the housing market, there's the inventory is way higher, so expect that. Let's see. I do want to look at the okay, urban consumers CPIU increased 2.9%. So that was better than the 3% that was the expectation. Let me just scroll back up. I want to make sure that I haven't missed something. Okay, so food 0.2, away from home 0.1. So energy, gasoline still flat. Energy services, or they were flat. So this inflation report is not that impressive if you look at it this way, but you do want to kind of just have a breakdown and take a look and see which items are deflationary, and some of them are very inflationary, like the car insurance, right? New vehicles went down, so the used vehicles went down by negative 2.3%. But if you look on the far right side, it'll say, let me see if I can highlight this. Can I? No. Okay. So it's down 10.9% year over year. Apparel, it looks like clothes are coming down as well, which is good. Shelter. So shelter went up by 0.4%, but it's been pretty consistent, 0.4, 0.2, 0.4. And housing prices are, I would expect them to go up even higher when interest rates start to come down even more. So I would say like September first rate cuts, and then November, and if they do another rate cut, I would say that the mortgage rates keep dropping, but the housing prices, home prices, they will continue to go up, because one, people are going to come out and say, well, I'd rather pay for 5.5% instead of 6%, and people are going to try to buy more homes to lock in those interest rates, because they don't know what's going to happen in 2025, 2026. So that would be something that you do want to pay attention to. Transportation services still continuing to go up, and it's up 8.8% year over year. Let's see. Don't need an explanation of the CPI. I do want to take a look at airline fares. It's down again. So wow. So it's even a really, really good time for anyone to travel right now. And I don't know if you saw that if you shop at Costco, you can get Southwest Airline gift cards for $500, but you only pay like $420. I think I got some of those on sale. I don't know if you fly Southwest, but you can see that the airline fares are coming down, and the discretionary spending is coming down. Let me take a look here. Airline fares. Okay. Not bad. Yeah. It looks good. It's just that I need to dissect a little bit, but I can't really stay on the live stream for that long. But just take a look. It looks pretty flat and unimpressive, but at the same time, the headline CPI did come in at 2.9%, so people are happy about that. So let me turn it into Bloomberg just real quick.
Risk of a domestic cyclical story versus a global deflation story. And this really is the end result debate we were talking about.
Good morning
earlier.
to you.
This is the discussion: deflation versus cyclical inflation, globally versus domestically. Where do we pan out on this? David's right. Inflation has been coming down slowly. It's coming down slowly primarily because there is this real battle going on between these two forces. And the problem I see is if you start backing away from the pressure that's allowing you to achieve your target, you might wind up creating an environment where you stop improvement towards your target.
But what would you say to corporate CEOs that continuously say they are seeing this slowdown from consumers? They do see consumers deferring big spending.
Again, after an environment,
the market's pretty flat right now based on the inflation report, because I don't think they're impressed either.
And
I'm not.
that's a
and
real
it's just kind of like,
inflection
hey,
point. By the same
2.9%, good for
You
you.
have services where spending is doing exceptionally well. And I think that becomes part of the problem. Again, it's goods versus the services side of the equation. Services are doing extremely well. You're seeing that in some of the components that people want to throw out of the CPI report. The reality is it's services that matter domestically. It's goods that matter globally. Globally, it's a deflation story. Domestically, it's a cyclical inflation story. The currency sits in between the two, and where the currency goes from here will be critical. If we get back to 100 on your DXY measure from having been as high as what, 113, 116, that's a huge depreciation in the currency. And you could start to see some of these benefits on the good side of the inflation dissipate at the same time that you may see a little weakening in the service side of the inflation, and you wind up stuck at 3% inflation. Now, if the Fed's willing to be stuck at 3% inflation, fine. Bonds have to adjust to that.
David, we'll let you respond in just 1 second.
Yeah, we'll see what happens with that, but the discretionary spending is absolutely down. But the next one I do want to pay attention to is, so the next inflation report comes out September 11th, and then the Federal Reserve, they're going to make their decisions on the interest rates on September 18th, so a week after that. So mark it on your calendar on what's going on. I also want to look at the Q2 GDP, the second estimate that is coming out on, oh my gosh, when is that coming out? 2 weeks. So it's coming out in 2 weeks on August 28th. We already got the first estimate. I believe that was at 2.4%, but the second estimate, and then we're going to get the third estimate on the Q2 GDP, and then we're going to get the Q3 GDP way down the line. But we do want to take a look and see where our economy is. Another PC inflation coming out on August 27th. So I do go live every single time CPI comes out. And as inflation starts to ease up a lot more, like let's say it goes to, 2% eventually, I'm probably going to stop going live on those days, but I do want to pay attention to the labor report. So, we'll see what happens. And obviously I will be going live stream every single time the Federal Reserve has a meeting, and, watch Jerome Powell's press conference together and whatnot. But yeah, I know there's a lot of uncertainty in the world, a lot of volatility in the market. But if you're brand new to investing, just stay invested. Don't time the market. Just stay in the market. Okay. Even if there's when the market was down by 5%, 6%, almost 8% since the beginning of the month, and people who bought the dip is already on the upside, and people who sold have lost. So just keep that in mind. If your time horizon is far out, stay invested and always buy. Okay. So I appreciate you guys being here. And if you haven't subscribed, just go and subscribe, and let me know if you guys have any suggestions in the comment section. All right. Have a good one.